and clear push towards the new regime. Sorry about this. So over to you, Ishu.
Yeah, thank you. Thank you so much. I hope I'm audible. So coming to personal tax. So we all know it is one of the areas where, the expectations are always on the high when it comes to Union Budget 2023, because it impacts the individuals at a personal level from the direct tax standpoint. So we all know there are two individual tax slabs at the moment. One is the old tax regime, and second one is the new tax regime. So there is no change in the old tax regime, and the old tax regime, the slab rates were changed last in the year 2013, and no change has been made after that in the old regime whatsoever. So the new regime came in, and it was it came in with no reductions at all, and now they have started liberalizing it. So in this budget, new tax regime has been given due importance, and has been liberalized to a certain extent, so that more and more people should shift towards the new tax regime. Because in a if I talk about numbers, if if I say, let's say, some 7-8 crore returns were filed last year at the individual level, but there were very less number of returns which were filed under the new regime by individuals. So the new regime was not at all actually followed by the individual. It was not actually, people did not opt for it. So they made it, a little bit interesting this time by changes like they have extended it to association of persons, popularly known as AOPs, body of individuals, as well. Earlier it was not there. It has been made the default regime, which means at the time of filing of tax return, if we want to opt for old regime, we have to specifically select the old regime, which was not there earlier. It will by default show us the new tax regime option. Number of slabs has been reduced to 5 from the existing 6, and also the basic exemption limit, that is the maximum amount which is not chargeable to tax, has increased to rupees 3 lakhs INR, and it remains the same 2.5 lakhs in the old regime. So 3 lakh basic exemption limit has only increased for the new regime. The slab rates has been reduced in the new regime, and it is in front of you. Up to 3 lakhs nil, 3 lakhs to 6 lakhs it's 5%, 6 to 9 10, 9 to 12 15, 12 to 15 20, and above 15 lakhs it's 30%. Also in the new regime, other benefits which have been proposed to be extended is the standard deduction of INR 50,000, which is there, which has been there in the old regime since many years, and now it is extended to the new regime as well. It was not there earlier. The maximum surcharge on the high net worth individuals is actually the highest in the world in India. So it was basically 37%. So it was actually one of the highest in the world. So now they have reduced that surcharge rate to 25%, and the effective tax rate for those category of taxpayers is reduced to 39% from the erstwhile 42%, which is a very welcome move. So the government actually intends to put more thrust on the new tax regime, liberalizes it to some extent by these measures, and the surcharge reduction is a very welcome relaxation for the high net worth individuals, I would say, and this will definitely encourage the wealth generation. I would like to mention that our partners have been quoted in the media as well on the said stories, whether it's Daily Pioneer, Z Business, and other eminent newspapers. Like I said, Section 87A rebate has also been extended, has also been increased rather to 7 lakhs. It was 5 lakhs in the old regime earlier. So now it has increased to 7 lakhs in the new regime. And then which effectively means there is no tax till 7 lakh rupees for the people who opt for the new regime. Again, this is effective from financial year 23-24, which means AY 24 and 25 and subsequent assessment years. So basically, this will leave more income in the hands of the taxpayers. The individuals having, packages up to rupees 7 lakhs or having incomes up to rupees 7 lakhs in a year, they do not have to pay any tax because they'll enjoy the rebate under section 87A of the Indian Income Tax Act. So a very important point, once again, this is not applicable to the taxpayers who opted for the old tax regime. Again, we get quoted in the media stories as well on this particular aspect too, in CNBC TV 18 and so on. Another important change which has come for the individual taxation space is the taxability of the life insurance policies. We all know that the majority of the life insurance policies was exempt earlier, and now for the policies in which the premium is above 5 lakhs and the policy which will be taken after 1st April on or after 1st April 2023, and the premium of that policy is exceeding 5 lakhs in any year, so that the maturity amount will be taxable. And this basically, the reason behind this particular change is the life insurance policy came in as a welfare measure for the people of the country, to protect to protect the interests of the people, and not something as an investment tool. So this particular product was actually getting used on a massive level as an investment tool, and thereby the high premium paying policies have been brought under the tax net. And this again, like I said, this will apply to the life insurance policies which will be taken on or after 1st April 2023, and not for the policies which have been already taken before that. And this will accordingly apply to the subsequent assessment years. So we have actually made a simple table to comprehend it better, where in this example, Mr. A has taken 2 policies and he has paid annual premium during financial year 2023-24 in this manner prescribed. So he has 2 policies. Mr. A has taken 2 policies. In one case, there are different scenarios, basically, like you can see. In the first case, it's 4 lakhs annual premium in policy 1 and the 3 lakhs annual premium in policy 2. Both the policies are separate and independent of each other. So what is going to be the tax implications at the end for Mr. A by virtue of this particular change which has been proposed is, since no premium in either of the policy is exceeding INR 5 lakhs, hence there will be no tax implications. Again, in second scenario, the premium paid is 5 lakhs and another policy premium is 4 lakhs. There is no tax implication since the premium in either of the policies is not exceeding 5 lakh rupees. Another example, policy 1 premium is 6 lakhs, policy 2 is 5 lakhs. Now tax implications would arise only and only in case of policy 1, no tax implications in the case of policy 2. Fourth scenario, where both the policies are exceeding the threshold, which is 5 lakh rupees. So in this case, tax implications would arise in case of both the policies, and the sum so received, which exceeds the amount of premium paid, would be taxable under the head income from other sources. Another change which has come in is in section 9, which will apply to resident but not ordinarily residents. So resident but not ordinarily resident is a special residential status in the Indian Income Tax Act. So in 2019, I would like to mention here that section 9 is that deeming section which deals with the income deemed to accrue or arise in India in the hands of non-residents. So 9(1)(vi)(i) is the clause which provides for the deeming fiction and states that any receipt of INR 50,000 or more by the non-resident without any consideration, this basically means gift from a resident of India, it shall be considered as income and thereby it will be taxable in India. So non-residents were not there in section 9 in terms of this particular clause, in terms of this particular gift clause until 5th of July 2019. With effect from 5th of July 2019, non-residents were, they got covered here. And in Union Budget 2023 proposal, which, the budget which came on 1st Feb, the deliberation of the same, which is happening right now through this webinar, it's actually sought to cover RNOR as well. So basically, the scope of the section has widened, but the treaty benefits may be explored in the best interest of the taxpayer. This will definitely widen the tax space, because earlier what used to happen is RNORs used to receive gifts from the person resident in India, and they do not end up paying any tax on it. So, however, the relatives will continue to be exempt, but in case of those transactions which is not happening between the relatives, now that particular gift will be taxable in India as the income deemed to accrue rise in India in the hands of that RNOR. Change with respect to market-linked debentures. This is particularly a change which has actually hit market-linked debentures industry really hard. So in a way, that market-linked debentures are hybrid securities, they're quasi-debt instruments, and they're listed. So they used to enjoy a 10% rate without indexation. So mostly wealthy families and high net worth individuals use it as an investment product. They invest in it, and the gains on the market-linked debentures were enjoying a lower tax rate of 10% without the benefit of indexation, which has been now proposed to be taxed as short-term capital gains at the applicable tax rates, which can increase up to 30% depending on the individual's slab rates. This is again applicable from financial year 23-24, assessment year 24-25, and the subsequent assessment years. The impact, like I said, it has hit this product really hard, because it will be less lucrative now, because the only lucrative thing associated with this particular product was the tax advantage, and the tax advantage is seemingly gone now, and it'll be less lucrative, and the people may start switching to other popular products like mutual funds, etc.
Just very quickly on that. So we spoke to many wealth managers, and they have said that effectively this will kill the MLD as a product, because that the main attractiveness of the product was that it was much tax efficient than fixed deposits, and with that being gone, this would actually no longer be that popular. Let's say it will basically kill it. So that's what our conversations with many wealth managers where we have discussed that. So going forward, so this was a market neutral strategy, especially in high markets where you have such high valuations. So there, that time it had become very popular, and many wealth managers used to issue this out of their own book, like IFL, Anand Rathi, and all. Please go on to the next. Thank you.
Yeah, thank you. So prevention of double deduction. So we all know this. We all know this section since beginning. So we all buy a house, and if in case we buy a house on the loan, so we know that we get the interest deduction under section 24, and we get the principal repayment deduction as well in section 80C. So what used to happen is, there was no explicit provision on at the time of selling of such residential house property, whether the interest that we have paid should be included in the cost of acquisition while computing the capital gains at the time of sale. So now it has been explicitly clarified through the Union Budget 2023 proposals that it will not be allowed. So what's basically this? What does this basically mean is, if we have taken the interest on loan deduction while computing the income from the house property, we cannot include it in the cost of acquisition or cost of improvement both while calculating the capital gains if we sell the property, like at the time of selling of that property. So it has been a very controversial topic in this house property space. There have been many divergent rulings in this aspect as well. There have been many tribunal rulings, like there is Chennai tribunal which is in the favor of the taxpayer, and there is another ruling of the Karnataka tribunal. Like, there are very divergent rulings in this particular space which says that it should be allowed. And another important ruling. It's an old ruling, but it's the ruling of the Supreme Court, which I would like to mention here, is of Escorts Limited 199 ITR 43, which analyzed this particular issue and gave its observations on this claiming double deduction in the hands of the taxpayer. And it held that double deduction is something which cannot be a matter of, let's say, inference or analysis. It should be provided for in an explicit manner. It should be provided for in a very clear and express language, rather than rather than thinking that whether it should be allowed or whether it should not be allowed. So basically, it was subject to litigation. So this particular issue has been brought to rest now through this change. Oh God, exemption of capital gains restriction. So section 54 and 54 is restricted to INR 10 crores now. So this basically means if someone buys a property worth rupees 12 crores today. So what earlier used to happen is, if one has sold the property and that that person has reinvested that amount into another house property, so that was eligible for the capital gains exemption to any possible limit. So there was no limit at all. So now the restriction has been imposed to the extent of INR 10 crores on it. So if this effectively means, I'll come back to my example. If a person has bought a property for INR 12 crores, so while computing the capital gains, the cost of such property would be limited to 10 crores only, and the remaining 2 crores would be subject to capital gains. The whole 12 crores won't be allowed as an exemption to the particular taxpayer. So again, the impact of such particular amendment is, again, people who are buying expensive residential properties, luxury villas, so they have been restricted. So their exemption has been restricted to INR 10 crores only.
So just one thing, many founders of startups and key employees who had good exits from stock options, they had actually used this route to claim exemptions because they were sitting on substantial gains, and that was the only way to claim it tax-free if they were Indian listed shares. So this would hit them very hard because a lot of people had invested into high-end properties where they got good exits.
Yeah, that's absolutely correct. Yes, that's right. Thank you. So another it's not some SFT reporting. SFT reporting is not related to personal tax, but in a way I want to cover it because it's a very significant amendment which has been proposed. So SFT is a return which is to be filed by every reportable institution prescribed under section 285 PA of the Indian Income Tax Act. So there are penal provisions for filing inaccurate SFT return. So for corporates, if they receive any share application money exceeding INR 10 lakh rupees, they have to report such particular transaction in a statement of financial transactions by 31st of May of every year. So there was no such penalty on the account holder. Rather, there was a penalty on the institution, but there was no such penalty on the account holder. So in a nutshell, the account holder's details go into the particular return, and it is only filed by the institution in that respect. So I think this penalty will actually make this SFT filing quite transparent, and it's a good move. It's a good change in terms of this particular in this particular SFT filing compliances, and this penalty can be recovered by the by the institution from the account holder. So this was on personal tax and the changes related to SFT filing compliances. Now coming to startups, and I'll hand over to my partner, Mr.